Welcome to my second pink cast for Chapter 11. In this cast, I want to do two items. I would like to look at sales tax payable, and I would also like to review something you've been doing since Chapter 2, Unearned revenues. If you would like to skip to either part of this pink cast, please touch the star located next to the name, in this case sales tax payable, and it will advance you to that topic. So let's start with sales tax payable. If you live in a state that charges sales tax, you need to add it onto the price of your sales. Then you need to collect it on behalf of your state government, yes sir, and then submit it. So you collect it and submit it, and it's never yours. You're just acting as a conduit, receiving it on behalf of the governor. Sales tax in Utah is roughly between 6 and 7%. So we'll use 6% in our example. And sales tax, by the way, is always a current liability. Depending on the amount you owe and the state you live in, you're not going to have a lot of time to remit it. So it's always going to be showing up as a current liability on the balance sheet. In our example, let's use a sale where we have a sale of $100 and we have sales tax rate of 6%, so you're going to add $6 on. So the total cash that we're going to receive is $106. $100 for the sale of the merchandise, $6 for sales tax, total of $106. If you are adding the tax on and identifying it from the beginning, it's a simple matter of making this journal entry. You'll have cash of $106. You'll have sales tax payable, the amount that does not belong to you, but you're just collecting on behalf of your state. And then you'll have the amount of your sales. Notice sales tax payable is a liability. It's a simple entry when the sales tax is added on. Some companies don't add the sales tax into sales tax payable. Rather, they collect the whole amount and they put it into sales. And then at the end of the month, they need to determine how much belongs to sales tax. If you look in your sales account and you find that you have not broken out the sales, but you have $106 in your sales account, how much of that actually belongs as sales tax and how much is actually for the sale itself? Calculation would involve taking the total amount and dividing it by 1 plus the sales tax rate. And since we're using 6% in our example, if you take the total amount in your sales account, you would see divided by 106, and you would see when you complete that the sale was $100. So in effect, you could back into how much sales tax you owe. Sales would be $100, sales tax payable would be $6, and cash received would be $106. This is in the case when the sales tax is not recorded directly as part of the journal entry to record the sale, but everything is recorded into the sales account. At the end of the month, you need to calculate what sales tax is. When, either way that you go, you remit sales tax to your state authority, the entry is simple. You look at what's in the sales tax payable account. In our case, we have $6, and you write a check to the governor. Not really, it's probably the state tax commission for the amount in that account, and send it off. Again, the timing depends on the state. but it will always be a current liability because none of them will allow you a long period of time. Let's move now on to our second topic, unearned revenue. Sometimes, in the course of this business, the situation requires that you collect money in advance. No one's ever going to whine about getting paid early, are they? So, I'm going to remind you of that situation. We started looking at it in Chapter 2. In our example, let's say you're an insurance salesman and that you sell someone an insurance policy, and the insurance policy requires they pay $100 a month for insurance, and further the terms state they have to pay 6 months in advance. So the first thing that will happen to you, the person providing this insurance, is that you will receive a check for $600. And on the day you receive this check, you have not earned any of the check. 100% of the balance would go into unearned insurance premium revenue for $600. Well, I could have abbreviated that a little bit, huh? So $600 cash and insurance premium revenue, $600. And what this did on the balance sheet is, this is an important thing to note, it made cash bigger and it made your current liabilities bigger, because at this point in time you owe someone 6 months worth of insurance coverage. At the end of each period, and I'm going to assume monthly now, you need to make an adjusting entry to show how much of that insurance you've earned. At the end of our first month, we have earned $100 of the unearned insurance premium, and so I would debit unearned insurance premium revenue for $100 and transfer that into insurance premium revenues. I'm going to abbreviate that, insurance premium revenue, showing that I have now earned $100 of that prepayment that they made. On a balance sheet, this drops the liability and moves it into revenue. In our first example, we were in balance. There's an increase in assets, an increase in liabilities. In our second example, our equation's still in balance, a decrease in liabilities and an increase in revenue. If you were to take a look at what's in insurance revenue at this point in the general ledger, you would see that you have $100 in it at the end of the first month. And if you were to look in the unearned insurance account, unearned insurance premium, the liability, it would have started with $600, and at the end of the first month you would have removed $100 and it leaves a balance of $5. At the end of the second month you will recognize another $100 and take it out, and it will leave a balance of $400. At the end of the third month you will move another $100 out from the unearned account and move it into insurance revenue, and each will be $300. You will have earned 1/2 of the premiums you've already collected. By the end of 6 months, insurance revenue would have a $600 balance in it, and the unearned portion would be paid down to $0. So, thanks for joining me in my second paycast on unearned revenues.